DeFi. What is it and how does it work? Decentralized finance, or DeFi, was coined in a Telegram conversation in 2018. That's when a group of software engineers and entrepreneurs struggled to come up with a name for their movement of automated blockchain-based financial services capable of displacing traditional banks. 3 years later, DeFi is an immensely popular business. DeFi is a combination of encryption, finance, and software development, and it has its own language and terminology. Let's break it down one piece at a time. DeFi stands for decentralized finance, an umbrella word for a number of cryptocurrencies and blockchain-based financial applications aimed at disrupting financial intermediaries. DeFi is inspired by blockchain, the technology that underpins the digital currency Bitcoin. Blockchain allows several organizations to keep a copy of transaction history, ensuring that it is not controlled by a single central source. This is significant because centralized systems and human gatekeepers may slow down and complicate transactions while giving customers less direct control over their funds. DeFi is unique in that it extends blockchain's utility beyond simple asset transfer to more complicated financial applications. Bitcoin and many other digital native assets differ from traditional digital payment systems like Visa and PayPal in that they eliminate all intermediaries from transactions. When you pay with credit card for a coffee at a cafe, a financial institution sits between you and the business with control over the transaction, retaining the authority to stop or pause it and record it in its private ledger. With Bitcoin, these institutions are cut out of the picture. Direct purchases aren't the only type of transaction or contract overseen by big companies. Financial applications such as loans, insurance, crowdfunding, derivatives, betting, and more are also in their control. Cutting out middlemen from all kinds of transactions is one of the primary advantages of DeFi. Before it was commonly known as decentralized finance, the idea of DeFi was often called open finance. How does DeFi work? The global economy today is based on diverse systems that entrust massive centralized financial institutions with substantial sums of capital and arbitration. This makes it difficult for new customers to gain access to and participate in financial markets. It also makes it difficult for developers to create new financial products. With such a fragmented and high-barrier economic landscape, the financial system becomes sluggish, opaque, and occasionally unreliable, unable to keep up with the customer demand while simultaneously taking on systematic risks. Public blockchain infrastructure, on the other hand, is based on the open source movement, allowing anybody with an internet connection to access a global decentralized and peer-to-peer financial system without ever having to commit their assets to a custodian. Because DeFi apps share the same infrastructure, i.e. a blockchain, their underlying logic is enforced by an intrinsically safe and deterministic environment, allowing for total transparency of the system's rules and seamless communication across various DeFi applications. Users have more trust than their financial agreements will execute exactly as designed, since the code that powers DeFi applications is open to everyone to audit. An open access financial system not only lowers development and compliance costs for developers, but also enables economic bridges across previously disparate economic divisions. The design idea of permissionless composability distinguishes decentralized finance from traditional financial infrastructure. Composability permits the DeFi ecosystem's numerous components to be merged to form a structure that is larger than the sum of its parts. Because they may use pre-existing open-source infrastructure for some components, DeFi developers can focus on their own application's unique business logic. What are the components of DeFi? Decentralized finance consists of 4 discrete layers: settlement, protocol, application, and aggregation. Settlement layer. This layer underpins all DeFi transactions, allowing you to conduct public financial transactions utilizing an open-source blockchain and its associated cryptocurrency, such as Bitcoin, BTC, or Ether, ETH. These can range in size from the massive Bitcoin blockchain network to small homegrown blockchains like Dogecoin, which grow rapidly dependent on user involvement with the underlying computational algorithms that produce the value of the digital currencies they support. Protocol layer. DeFi systems are often based on software, layer 1 or implementation protocols. These offer a standard underlying architecture and set of rules on which the blockchain network is built and which both users and developers may utilize to conduct digital token transactions. In this way, the protocol layer makes it possible for digital currencies to be liquid and have a monetary value. Application layer. This layer is made up of all the public-facing programs, apps, that let you purchase, sell, or trade the digital tokens, typically cryptocurrencies, that are produced and controlled by blockchain networks. Aggregation layer. The aggregation layer is generally made up of services that collect or aggregate consumer-facing apps. So the consumers may purchase, sell, and trade numerous digital tokens and currencies across multiple blockchain networks. Most users will view and access this layer of the DeFi system, often without ever having to interface with the underlying blockchain networks and software protocols that underpin the whole DeFi system. What are the pros and cons of DeFi? DeFi has a number of significant advantages, including cost, speed, and security. Blockchains and cryptocurrencies are accessible to everyone with an internet connection. Users may trade and shift their assets at any time without having to wait for bank transfers or pay bank fees. DeFi is lightning fast. Interest rates are updated numerous times each minute, and the blockchain is updated as soon as the transaction is completed. Due to the open nature of DeFi, every single transaction is visible to the whole public. You may also invest in securities and engage in peer-to-peer transactions. DX.Exchange, for example, is a Nasdaq and MPS Marketplace Services Limited-backed platform for trading and investing in tokenized equities. If the seller accepts and you locate an abstract firm ready to deal with DeFi, you might purchase a property with crypto. By converting crypto into cash, emerging technologies like BitPay may be used to make purchases for actual things that are traditionally paid for in dollars. Another possible benefit of DeFi was demonstrated by the economic impact of COVID-19 and how banks responded. Some central banks reduced interest rates in reaction to the pandemic slump in order to keep consumer spending going and safeguard the community. However, this reduces savers' effective net value. A central bank's ability to control the value of its currency would be far more difficult, if not impossible, under a DeFi system. DeFi, in other terms, allows customers to protect their assets' value against central bank manipulation. DeFi, on the other hand, has several drawbacks. Users of DeFi are unable to protect the value of their assets against market fluctuations. Values change a lot and they fluctuate a lot. Because Ethereum transaction rates change, trading might get pricey. Furthermore, because dApps are a relatively new technology, flaws or liabilities may develop in the future. Furthermore, there are a variety of tax issues associated with acquiring, trading, and investing via DeFi. DeFi and cryptocurrency security has also been questioned, particularly when hackers stole $600 million in Bitcoin from Poly Network, a blockchain connecting platform, in August 2021. Finally, the shape of developing policies and regulatory frameworks is still a work in progress. It's unclear how regulators will react to stablecoins coexisting with central bank digital currencies in particular. In addition, a clause in the $1 trillion federal infrastructure bill adopted by the Senate in August 2021 requires cryptocurrency brokers to record transactions of $10,000 or more to the IRS. The law is intended to improve tax collection in order to help pay for infrastructure expenditure, but Bitcoin industry opponents believe the clause is too broad and would hinder innovation. How to invest in DeFi. Investing in DeFi may be done in a variety of ways. Buying Ether or another coin that employs DeFi technology is the easiest method, but it only offers broad exposure to DeFi. Purchasing a DeFi-powered coin gives you access to almost the entire DeFi business. To earn money on your Bitcoin holdings, you can deposit it directly with a DeFi lending facility. If you are ready to deposit cash for a longer period of time, you can get a greater interest rate, and the interest rate paid on your deposit can be fixed or variable, changing with the market. The practice known as yield farming has evolved as a result of the increased demand for deposits across the numerous DeFi platforms. Yield farmers deposit funds on whichever site offers the best interest rate or other incentives, and they keep an eye on other platforms' current interest rates and incentives. If other platforms begin to provide a stronger incentive, the yield farmer will move their deposits to the new platform to maximize their earnings. Yield farmers continue to migrate their capital from platform to platform as incentives vary. You can buy a token like Uniswap's Uni if you wish to have a say in the development of DeFi protocols. Uni, also known as a governance token, grants you decision-making influence over the future of the Uniswap protocol in proportion to your ownership. The future of the service becomes of more relevance to more people as more individuals engage in the decision-making process and acquiring Uni coins, and increasingly significant holdings of Uni are necessary to retain substantial decision-making influence. This dynamic has the potential to cause the token's price to skyrocket. The final result is that at this point, DeFi's popularity and applications are expected to continue to expand. DeFi technology will be used in increasing numbers of organizations and customers in the next years, since it has shown to be quicker, safer, and smarter than traditional financial instruments and infrastructure.